Following a landmark 2025 that saw Bitcoin reach an all-time high of $126,000, and as the market settled into a year-end consolidation, the narrative has shifted. We are no longer asking if Bitcoin will survive. We are asking how it will redefine the global macro landscape. Today, we examine why this year marks the dawn of the institutional era, a structural pivot where macro flows and regulatory clarity are finally overriding the. To understand 2026, we must look at the foundation laid over the past 12 months. 2025 was the year the crypto wall between Silicon Valley and Wall Street finally collapsed. The catalysts were relentless: the inclusion of Coinbase in the S&P 500, Strategy's ascension to the Nasdaq 100, and perhaps most critically, a U.S. administration that pivoted from skepticism to strategic adoption. By the time Bitcoin crossed the six-figure milestone in late 2025, the retail FOMO of previous cycles was noticeably absent. In its place was something more formidable: passive, programmatic, and permanent capital. However, the year ended with a reality check. After the October peak of 126,000, we saw a 30% correction to the $88,000 range. To the uninitiated, it looked like the start of another crypto winter. But to institutional allocators, it was something else: a healthy re-rating, a transfer of supply from weak hands to long-term sovereign and corporate treasuries. The central debate for 2026 is the survival of the four-year cycle. Historically, Bitcoin's price action was dictated by the halving, a mechanical supply shock that occurred every 4 years. But in 2026, many analysts, including those at Grayscale and Fidelity, are declaring the cycle dead, or at least fundamentally altered. The reason? The spot Bitcoin ETFs. Since their inception, these instruments have acted as a massive liquidity sponge. In 2025 alone, they absorbed over $50 billion in net inflows. This isn't hot money looking for a 10x return in a week. This is retirement capital, 401k allocations, and wealth management rebalancing. In a traditional cycle, a 30% drop would trigger a liquidation cascade. In the new institutional era, that same drop seems to have triggered a buy-the-dip response. This maturation is leading to yield compression. Yield compression refers to the narrowing of the excess returns, or alpha, that investors use to earn from Bitcoin's inefficiencies. As Bitcoin matures more into a regular part of institutional portfolios, the massive price swings and high-yield arbitrage opportunities that defined its early years are being squeezed out by professional capital. Think of it as the professionalization of the asset class. As more sophisticated players enter, the market becomes more efficient, and the easy money disappears. Volatility, while still high compared to the S&P 500, is trending downward. Bitcoin is behaving more like a Nasdaq stock, an asset in a growth sector that thrives on a bit more stability and predictability rather than chaotic speculation. Despite the 2025 rally, global debt levels continue to hit record highs. Central banks are once again caught between the hammer of persistent inflation and the anvil of slowing growth. As the Federal Reserve enters an easing cycle in early 2026 to support a cooling labor market, the opportunity cost of holding Bitcoin is falling. In a world where the purchasing power of the dollar is designed to erode at 2 to 3% per year, Bitcoin's fixed supply of 21 million coins is no longer a fringe theory. It is a corporate treasury strategy. We are seeing the rise of the sovereign Bitcoin reserve. Following the passage of the Digital Asset Market Clarity Act, we've seen small to mid-sized nation-states begin to mimic Michael Saylor's playbook with strategy, diversifying their national reserves into Bitcoin to hedge against currency fluctuations. This creates a price floor that previous cycles simply didn't have. So, where does the price go from here? The consensus for 2026 is not one of moonshots, but of a disciplined grind higher. JP Morgan and Standard Chartered have clustered their 2026 targets between $100,000 and $170,000. This assumes a slow bull scenario where ETF inflows remain steady at $1 to $2 billion per month. However, the path is not without its landmines. The primary risk for 2026 is ETF contagion. If we see a major macro shock, a geopolitical event, or a systemic banking failure, institutional investors may be forced to liquidate their most liquid risk-on assets to cover margins elsewhere. In this scenario, the very ETFs that provided the floor could become the ceiling, as massive outflows overwhelm the market's remaining liquidity. Furthermore, regulatory clarity is a double-edged sword. While the Digital Asset Market Clarity Act provides a framework for growth, it also brings stricter reporting, taxation, and KYC requirements. The days of anonymous price discovery are over. Bitcoin is now fully integrated into the global financial surveillance apparatus. We are moving away from the era of if and into the era of how much. How much of a pension fund should be in Bitcoin? How much of a national reserve? The 2026 outlook is one of cautious optimism. Perhaps some of the speculative froth of 2025 has been washed away, potentially leaving behind a more resilient market structure. It is clear that Bitcoin is no longer just a digital currency. It is a global, neutral settlement layer for the digital age. For investors, the message is clear. The volatility is the price of admission, but the maturation is the reward. The cycle hasn't ended, it has simply evolved.